Hello, this is Marty Vasquez with MJ Real Estate. Some people had asked me to describe the owner finance business model, so I thought it would be easier to put together some slides and just talk about the business model and why it is one that real estate investors ought to consider to at least have as part of their tools in their real estate investing endeavors. Just a quick disclaimer here, we're not attorneys, we're not accountants, we're not certified financial planners or anything like that. This is just our opinions and uh, what we're doing in some cases when it comes to real estate investing. Also, thanks to Mitch Stephen for putting these slides together. We are real estate investors. We specialize in creative acquisitions, financing, and creative selling. Most people are familiar with the traditional way of buying a house. You find a realtor, you go look at houses, you go to the bank, put a down payment, get your loan, and then similar on the selling side. So that's one way. There's a lot of other ways, and we have become experts on those other ways, and this owner financing model is one of them. So what we do is we buy distressed properties with borrowed money. We sell those properties to buyers with owner financing. Sometimes we'll do some repairs, sometimes we won't. It just depends on the individual property, and there's many other factors that go into that decision. But probably wouldn't be buying anything that looks like this, although it could. It depending on the deal, you might actually purchase something like that and be able to sell it to somebody with owner financing. So there are two exit strategies with owner financing. You can buy and fix it and get top dollar for it, or you can buy do not fix it and just sell it at a discounted price to somebody. Or I guess I should probably say there's three exit strategies, because you could also do something in between where you just do a little bit of some basic repairs if there are some immediate repairs needed, just so somebody can at least move in and live in the house right away. That would be another way to go. So in this model, uh, we think it's good because it works for everybody involved. We help sellers sell. Somebody's got a distressed house and can't afford to fix it up. We can help get that house back rehabilitated and functioning with somebody living in there. We're helping buyers that wouldn't otherwise be able to get a mortgage become homeowners. So that's a big plus for those people. We're helping lenders earn a decent rate of return secured by a first lien position on a valuable piece of real estate, something that you can go see, touch, you drive by it. That is a pretty secure position when you compare other investments, especially the stock market, where you don't know what will happen one day to the next. We help the neighborhood in turning distressed properties into pretty looking houses, and we help the local economy in a couple ways. When we uh, take a property that's distressed and then it becomes a functioning home for somebody, the property value will increase, the property taxes will increase. That will help the local school boards, the local government, the contractors go and work on the house, the Home Depot, Lowe's, Ace Hardware, all those stores that are going to be selling materials. The Burger Kings and restaurants, contractors will be coming to work there. They'll be buying stuff in the local area. So it helps a lot of people, and also it helps our business as well, which is why we're doing it. And if you think about it, who else is going to rejuvenate these neighborhoods if real estate investors don't go in and do this stuff? So uh, continuing on, to understand this owner finance business model, you really have to understand this core belief, this first core belief of this model, and that is that a person paying $1,000 a month to rent would rather pay $1,000 a month to own. And that kind of makes sense. It probably wouldn't be 100% true for everybody that's renting right now, but certainly a very high percentage of people would rather own the house than rent. The only reason they're renting is just because they can't get a mortgage. Uh, the the lending institutions, the rules and regulations that have been imposed on them by government has really um, has really hurt a lot of people. And this type of property, I mean, if you're going to go to Bank of America and try to get a loan for $50,000, uh, they're not going to want to do that loan because uh, they have to do the same amount of work to generate a $50,000 loan as they do for a $500,000 loan. So they steer away from those lower priced loans, and therefore it makes it a lot harder for people to get a loan, even if they are otherwise mortgage qualified. You just can't hardly find a bank that would be willing to do these small types of loans because they just don't make any money on them. So that's the first core belief, and so we're going to even reiterate here on this other slide. And this rhetorical question here: does it make sense? Does it make sense that a person paying $1,000 to rent would rather pay $1,000 to own? I think we could probably all agree that in most cases that is going to be a factual statement there. So um, there we go. So we already talked about this first one. Renters would rather own. And secondly, you also have to believe that there is a long list of people that if you were offered to offer a house in this manner, you're going to have a lot of people wanting to get in touch with you to buy that house. So that's why it works. There's a lot of people that we have a lot of customers, potential customers out there for this type of house. So that raises a question: how much would one of these types of buyers be willing to pay for an owner finance house? So I'm introducing here a new acronym, Owner Finance Value, OFV. So we'll be using that quite a bit on the next few slides. So what is owner finance value? Well, first, what it's not. It's not your appraiser going out to the house and doing a formal appraisal. It's not a comparative market analysis that realtors or anyone else would do. And it's not a broker's price opinion of value. So it is neither of those things, and those are the traditional things you would think of in the real estate world. And the owner finance value, it's a different value all into itself, and we're going to discuss that further here. So how do we establish what the owner finance value is for our purposes? I'll go through these, and I'm going to go through these kind of quick. You can pause this recording and go back and look at it if you would like. But the owner finance loan payment, when you sell the house to somebody with owner financing, they're going to have monthly payment of principal and interest, taxes and insurance. So what we want to do is we want to figure out first what the owner finance principal and interest payment is going to be. And what we want to do is we want to match that to the rent subtracted by the taxes and insurance, the monthly taxes and insurance. So we're going to take the rent and subtract out the monthly taxes and insurance. And that is going to equal what you can charge for an owner finance value principal in interest payment. So now that we know what the principal and interest payment is that we can charge, we can plug that into this formula here and say that the owner finance loan amount is going to equal the owner finance principal and interest payment times 115. And don't worry about why this number is 115. Just know that it's based on an assumption. We're using an assumption here that we're going to charge 10% interest for a 30-year loan. So what we figured out when you plug these numbers in here, it comes out to almost exactly this all the time. So just to simplify things, if you could just remember this multiplier here, 115 times the owner finance principal and interest payment. So um, now we know what the owner finance loan balance is that we could have this owner finance buyer pay, as long as they're paying that same amount, the monthly payment for owner finance principal and interest is same as rent, minus this number. We can say that the owner finance value of the house is going to equal the owner finance loan amount times 1.12. Well, now you're asking, where's this 1.12 coming from? Well, when you go buy a house anywhere, whether it's using a bank, say Bank of America, do you usually get into the house with no money down? No, of course not. So on these houses, you don't get to go into one of these houses with no money down either. So once we've established what the loan amount is, then we're going to have to add to that how much of a down payment we should reasonably be able to expect to charge a customer to purchase this house. So in this example, we're saying 12% interest. And sometimes it'll be a little more, sometimes it'll be less. It'll depend on the amount of repairs that the house needs. But this is a middle of the road number here, 12%. So the owner finance loan amount times adding 12% is going to equal the owner finance value. So this is an important number to realize here. This is how we get the actual owner finance value of the house. This is what we can sell the house to somebody for, assuming it doesn't need any repairs. Now if it does need repairs, then for our purposes we're going to subtract out 50% of the rehab budget. Now why 50%? If I were to go out and hire my contractor or go get 3 bids from contractors and pay them to fix up the house, let's say that the number they come up with is $30,000. Well, a big portion of that number is going to be labor, their own labor. So when we sell a house to somebody with owner financing and they're going to do repairs themselves, they are just going to be paying for materials. So we subtract out 50% of the rehab budget that we would be accustomed to paying. Now, it doesn't mean we're going to go have a contractor go over there and actually fill out line by line what needs to be repaired and come up with a number. No, we're experienced here. We're just going to make an estimate of what we think the rehab budget would be, and we're going to subtract an appropriate number. Now, you have to be reasonable here, because if you try to subtract too little when the house does need repairs, then you're just going to have a little harder time selling that house. And eventually you're going to have to either lower the price or just make a correction here. So just be realistic with this number here. We're not trying to take advantage of anybody here, but people will do their own repairs, and they will be able to do it a lot less than I or another regular professional investor would have to pay to get a contractor to do that same repair. So again, this is, I'll run through this real quickly again. So to get the owner finance value, you take the owner finance principal and interest payment that you want, and you're going to set that equal to the rent subtracted by the taxes and insurance. To get the loan amount that you're able to give to the buyer, you're going to take that principal and interest payment, multiply it by 115. So that'll give you a loan amount. Once you have that loan amount, you're going to add to that loan amount what you're going to collect for a down payment. So multiplying by 1.12 here is, just for this purposes, that's the number we're using. So that's how you get your actual owner finance value. And then adjust for repairs as needed. Core belief number 2 is understanding how that owner finance value is derived. So you have to realize that this is a real number. It's based on the market rent. Incidentally, what's easier to, which of the two are easier to come up with for a specific neighborhood? The average price of houses or the average price of rent? I would say it's a lot easier to go look at a neighborhood and see what houses are renting for versus going to see what houses are selling for. So you can really get an accurate monthly rent amount, which helps you get a very accurate owner finance value. And so owner finance value is a true indicator of value. That's our core belief number 2. Have to embrace that. So if we're going to go purchase a house, how would we make an offer on it? Well, first we would establish the owner finance value of the house, estimate the repairs. Once we calculate that owner finance value, we are not just going to go into it blindly. We are going to compare it to the regular market value for houses in the neighborhood. And generally what you're going to find in the houses that we're targeting for owner financing, the owner finance value is going to be a little bit more than what the regular comparative market analysis would show for that particular property. Right? So once you have your numbers here, then you know what your max allowable offer for, and for that it's just going to be different for every individual person, how much profit that you want to build into your transaction, and that will guide you in what you can pay as a max allowable offer. So here's a quick example. There's a your typical house. Looks like 1,200 square foot house with a converted garage. So here we're going to establish the owner finance value of this property that rents for $1,000 a month. This property, the taxes are $100 a month. The insurance is $50 a month. So we subtract that from the monthly rent, so we come up with $850 a month. That's what we can charge to the buyer for principal and interest payment. With our assumption of 10% in 30 years, we're going to multiply this number here by 115, and that's going to come up to $98,000. So this is the loan amount that we can offer to our buyer. So now we're going to collect a down payment above and beyond this 98,000 number. So for this particular house, didn't need a lot of repairs, so we're going to charge 12% down payment, 98,000 plus 12,000. So our owner finance value is $110,000. And we would do a comparison of that number to what houses are selling for when they sell in that typical or traditional manner, just to make sure we're not way off on this. So how are we going to go about making an offer? Now that we know what we can owner finance the property for, we can make the offer. So if we know we can owner finance it for 110, then again, you have to decide how much you're willing to pay for the property. In this example, we're saying that we had an offer accepted for $50,000. So maybe that house needed a little repairs, or for whatever reason the seller was needing to sell it quickly and didn't have time to list it. So we got the property for $50,000. We're not going to put any of our own money into it. We're borrowing an extra $2,000. I'll explain that in a moment. But so the total investment is $52,000. This money will come from the lending entity. So why do I borrow an extra $2,000? It's because it takes time and effort to find these houses. Quite simply, not to get too much into the weeds on that, but it costs money to find them. So our total investment is $52,000. We borrow this money at 8% interest, non-recourse. It's a collateral-only loan. The collateral speaks for itself here. You got $110,000 owner finance value, and you're only borrowing $52,000. This lending entity is in a very strong position. I hope you can see that. When you're borrowing not even half of the value of the house, should that lending entity need to foreclose, they have a lot of equity to protect their investment. So on this loan, 8%, $52,000, it's $350 per month. We have an owner finance value of $110,000. the lending entity has the first lien position. So I think you can see that the lending entity is in a very secure position here. Okay. Now, the 8% number, sometimes it could be a little more, sometimes a little less. It just depends on the lender. But this is a reasonable number given the collateral. Now, you could go and borrow money you could go spend the time and effort to refinance the property at a commercial institution and probably get, 5.5, 6%. So, we're gonna offer to pay a little more just for the ease of dealing with a private lender. So, if you aren't willing to pay this much, then you're not going to get as many people wanting to be lenders for you. So if you charge too much, if a lender is charging too much, then you'll be wanting to try to find a lender that will, obviously charge less. So 8% we found is kind of an in-between, where especially if the house is a very solid investment and the collateral is very good, 8% interest only, non-recourse is pretty fair. So when we sell the house, we're going to be selling it for $110,000. We got a $20,000 down payment. That would make the buyer's loan $90,000 at 10% and 30 years. That comes out to $780 per month for principal and interest. So a quick summary here is we collected $20,000. We borrowed all the money to purchase the house. We're collecting a $20,000 down payment, and then going forward we're going to be collecting $430 a month positive cash flow. So you can see that's a pretty good investment for us, and it's that we go back to that one slide where it worked for the seller, it worked for the buyer. The buyer's happy, the lender is happy. So this is a win-win-win all-around situation. And there's another quick summary of the total. If the property went out for 30 years, you would have had your $2,000 extra that you borrowed. Of course, that's going to go back into finding more houses. Then you got your down payment that you collected, and then the cash flow over 360 payments for 30 years. See that's a pretty big number. Most of the time, people aren't going to stay in a house for 30 years, so. And there's the numbers again. So you can see why this business is a lucrative business, doing the owner financing model. And it takes time and effort to find these houses and put it all together, and that's what we do. So how does this investment end? Well, let's take a look at these things here. So if the buyer pays off the loan over 30 years, they stay in the house for that long, then the lender's eventually going to be paid off, right? Number two, if the buyer sells the house, then they're going to have to pay off the loan. Okay? If the buyer refinances the loan, the lender is going to get paid off. And if the investor, if the investor were to sell the note, then he would have to pay off the lender as well. So you can see in all these situations, the lender is getting paid off. Okay. So what could go wrong? It can't all be just great win-win and nothing ever bad happens. And here's what could go wrong. But I think you'll see that you're still protected. Everybody's still protected here. So if the buyer, what happens if the buyer, something happens and they can't pay the investor? Well, the investor would foreclose on the buyer, and you would have to continue to pay the lender. If you're a landlord, if a tenant moves out, you got to clean the house and so forth. You don't just stop paying the bank while your house is vacant. So it's the same thing here. So if you're foreclosing on a buyer, then you would have to continue to pay your lender. You would resell the house, most likely at a higher owner finance value, and you would also collect another down payment. So that's not too bad. We don't want that to happen, but if it does happen, then we can still benefit from that. What happens if the investor doesn't pay the lender? Well, then the lender would foreclose on the investor, and the lender would either get the house or the lender could just take over the investor's position. And if they took over the investor's position, they're going to be getting a higher monthly cash flow, and they're going to have a higher outstanding loan balance. So the investor comes out okay here as well. So can you see how the lending entity is in a secure position here? That's how it's designed. So core belief number 3 is, will this business generate enough income to pay its obligations? If we can't answer that question in the affirmative, then we're not going to have many people wanting to be a lender for these deals. So obviously the answer is yes. So is this a fair transaction for everybody involved? For the buyer, for the lender, for the investor? And the answer there again is yes. It's fair. So here's a quick snapshot of the 3 core beliefs. Number 1, if the monthly payment's the same, most renters would rather own. The potential value of the house can be calculated based on the market rent. That's how we come up with the owner finance value. And then number 3, that this business will generate sufficient income to pay its obligations and create positive results for all people involved. Okay, so that's the summary there. Just a quick case study. This was actually not even a house. This is a lot that we purchased not too long ago. And what we did here is we purchased this lot for $44,000. We purchased it because it was there in a neighborhood where there aren't many lots available, and there are builders wanting to build homes. So we were pretty sure we'd be able to sell it. We got a private loan of $35,000. Didn't cover the full amount here, but I'll explain it as we go further along into it. The loan that we got was 12.5. We actually bought this property first. We did this one a little backwards. We used cash to purchase the house, and then after we had secured this buyer under contract, we then found a private lender willing to loan us $35,000, but that wasn't until we already had a buyer in place. And the reason it ended up being that way because it was not a house that's already built. It's just a piece of land. So once the lender could see that, yeah, there was a buyer willing to put money down, then they agreed to give us this loan. So the terms we agreed to was $35,000, 12.5%, 60 months amortized, comes out to $787.43. This is a high interest rate, but it still worked for us because we're amortizing this loan instead of doing interest only. So a portion of this money here is actually principal, and so our loan is paying down, and we use the same 60-month term when we sold it to the buyer. So the buyer put $20,000 down at 10%, 60 months amortized, and that was it, their payment. So look at the lender's loan to value here, 51%. Would you agree that's a pretty secure position to be in? So the upfront cash was that stayed in the deal from us. We received $35,000 from the lender, $20,000 from the buyer. Our outlay was $44,000 minus a sales commission. So we ended up with a plus $6,920 in our pocket, basically. So we ended up with a net cash up front and a positive cash flow at $232.43. So total cash flow over the 5 years will be $13,900. We've already collected $6,900. So this is a small little land deal. Total profit $20,000. There were some closing costs in there, so it's actually a little less than that. But you can kind of see in a nutshell that's how it works. It would work the same for a house, but in most cases in a house, you'll get your loan before you actually purchase the house. So There's that one. This is my contact information. Again, I'm Marty Vasquez from MJ Real Estate. And if you got any questions, feel free to call me here or email me here.